Lloyd, annual municipal bond performance last year was the worst since 1981. So what accounted for such poor performance in muni world last year?
Like all asset classes, the negative returns are driven by the Federal Reserve's aggressive rate hikes to try to bring down persistently high inflation. So we started last year in an ultra-low yield environment for fixed income markets. And the pivot from potentially dealing with a negative rate environment to one where the Fed looked to be behind the curve addressing inflation resulted in negative returns that were higher than we'd experienced during previous rate hike cycles. Municipal bonds tend to have lower price volatility than other sectors. So even though the negative return was high by historical standards, municipals actually fared better than most other asset classes.
Well, there you go. So we got a brand new year ahead of us. Why should investors look to put more money into munis this year?
So the Fed is expected to continue to hike rates till the middle of the year. However, yields in the fixed income markets tend to peak and even rally before the terminal rate on Fed funds is achieved. Specifically in munis, over the past 2 years, credit quality has been improving as a result of better than expected tax collections and additional federal aid due to the pandemic. So even though the credit environment has started to soften, municipals are in a strong position to manage the slowdown.
Okay, those are your selling points. What about the risk for munis in 2023?
The main risk will continue to be the level of inflation. So even though economic inflation indications have been trending down, the level of inflation is still higher than the Fed's desired target range. So we need to continue to see the reduction in the level of inflation. If that were to stall out, the Fed could feel compelled to raise rates by more than that is currently priced into the market.
And which type of munis do you like the best? Do you like the general obligations? Do you like the revenues? Do you like the sewers? What do you like?
They're all fine from a credit perspective. The biggest weakness we saw last year was more on maturity and bond structure. So investors were definitely defensive. They were looking for shorter duration assets, more defensive bond structures. So the most out of favor part of the market were longer maturity, lower coupon bonds. So these had widened out much more than your average muni and were the worst performing parts of the market. The additional yield priced into these bonds seems high given the current rate environment. So if you see any sort of stabilization in rates, these bonds should be the best performers this year.
Are there any great states or municipalities to find some high yielding municipal bonds? Do you want to get into Chicago? That's always a popular one for people looking for some yield.
Yeah, Chicago, Illinois, New Jersey were all in the news being weak credits, and they've all improved over the last 2 years. New Jersey was upgraded, Chicago was upgraded. So they still offer more yield than your average muni, but these are improving credit stories.
All right, Chicago's your kind of town. And finally, what about separately managed accounts versus holding your munis in a mutual fund?
So one of the big appeals of a separately managed account is the ability to customize. So individual investors could customize these portfolios based on their preferences. So they could target a specific duration, they could specify a maturity range they want to invest in, they could determine what kind of concentration they'd like in a state or a sector, and they're also able to exclude parts or certain securities that they do not want to hold in their portfolio. In addition, they also control the tax consequences of these portfolios, so they could determine when and if they want to realize gains or losses, and they also don't inherit the cost basis from a pooled vehicle for bonds purchased before you got invested.
All right, well, thanks a lot for coming on and talking about it.
Great, thank you.